Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for you in light of your financial conditions. Good afternoon. This is Oliver Sloup, Blue Line Futures, coming to you from the Chicago Board of Trade. Today is Monday, December 15th. It was largely a sea of red in the grain markets. Livestock a little bit more choppy. As usual, we'll get things kicked off with the March corn futures pulled up here. As you may recall, if you watched Friday's video, we settled basically right on trendline support. Unfortunately, that weakness on Friday bled into Monday's session, which gave us a break and closed below that. Futures basically tagging the 100-day moving average, or this blue line, to a T, 436 3/4. Below that, there's a little bit more support from these November 24th lows. That's 434.5. So 434.5, 436 3/4. That's the new must-hold line in the sand. A failure there, and we could see again another leg lower in the selling accelerate. Now, we did close off the lows, which was certainly encouraging, but we remained below trendline support, or what was trendline support. And for the bulls to really get the technical advantage back in their favor, at least neutralize some of the bearishness that's been developing over the last 48 hours, or the last two sessions rather, we need to see consecutive closes back above this 50-day moving average and the 20-day moving average, which was ultimately the breakdown point on Friday. So going into Tuesday's trade, that's going to be about 442, 443 3/4. To neutralize the bearishness that we've seen developing, need to get back out above there with consecutive closes. And potentially that opens the door for a retest of the top end of the range from the recent weeks. Now, fundamentally, there has been some things to be upbeat about. Last week's WASDE report was friendly. This morning, weekly export inspections, friendly, towards the top end of expectations. Also saw a flash sale of 150,000 metric tons to unknown destinations. So there are some little nuggets of friendly news. Unfortunately, price action is king. And the chart pattern certainly softening up here over the last couple of sessions. We'll see what the rest of the week holds, but we need to see these levels hold to keep that optimism and hope alive that we can get back towards the upper end of those ranges. Now, over on the soybean side of things, it just continues to play out. Almost textbook, that head and shoulders that we've seen developing over the last couple of weeks. We had a weak close on Friday. Again, that bled to weakness to start this week's trade, Monday's trade today. Working into that gap, not closing it all the way, but working into it and bouncing and closing off those lows, which is, I guess, a silver lining if you were a buyer in that gap. However, like corn, the bulls still have quite a bit of work left to do to get the ball back in their favor, or at least to neutralize the bearishness that's been seeping into the market over the last several weeks. 7 weeks lows for soybeans with today's close, which was down, down 5 cents, 10.71 3/4. So the levels that we're looking at going into Tuesday's trade, old support, 10.81, 10.86. The bears clearly have control of this chart. Consecutive closes back above 10.81, 10.86. That was the original breakout point and resistance, previous resistance back in February, May, June, August, and then the breakout point. So that was a clear inflection point for the market. That's going to be significant resistance going forward. The bulls need to see consecutive closes out above there. The next couple of trading sessions potentially could be telling and setting the tone going into the end of the year. Everybody watching to see if that gap gets completely filled. I still think that's going to be pretty solid support. As mentioned in Friday's video, we're kind of back near some price levels that we were trading at prior to when China was in the market and buying U.S. soybeans. So now that we're back to those levels prior to China being in the picture, potentially with China in the picture, even though it may not be up to the amount that some people want, they are back to buying U.S. soybeans. And so I would hope that that offers some sort of support. However, if that gives way, there's additional air underneath the market. 200-day moving average, that yellow line, 10.53 below that. Trendline support, low end of the range, is quite a bit lower. So manage your risk accordingly as usual. Keep an eye on Brazilian, South American weather. That continues to be watched very closely. Right now, weather looks pretty darn good there, and it seems like traders are pricing in potential bumper crop down in Brazil. Weekly export inspections for soybeans this morning, a little bit disappointing. Came in at 795,000 metric tons, so that was below the low end of expectation. So not super impressive on that front. We did have a flash sale this morning, which was encouraging, but again, we need to see those flash sales ramp up, not only in frequency, but also quantity. Now moving over to the wheat market, it just continues to bleed lower, and today really kind of breaking below this support pocket. retracing that breakout point or that big move higher from October 23rd. And if we can't get back above 528, 530, it really opens the door and keeps the door open for a potential retest of these October lows, which comes in closer to 508. So the bears, as you can see, in pretty clear control here. Probably getting a little bit oversold in the near term, though, so maybe right for a bounce. But again, as with corn and soybeans, the bulls need to see consecutive closes back above what was support. This support pocket is now going to be significant resistance, so keep that in mind going forward if you are trading these markets. Now, over on the livestock side of things, it was a little choppy recession, which is kind of what we've been talking about for the last couple of weeks. Is this market attempting to find a range? We're seeing volatility come in with the CME CVOL indexes or the indices for live cattle and feeder cattle basically trading their lowest levels since the start of November. You're seeing the 14-day average true range continue to contract. And now we're starting to see these daily ranges basically develop into a bit of a sideways trade. Now, I think that continues throughout the rest of the year. Potentially these ranges expand a little bit, but it's certainly not going to be, or what I don't think is going to be, what we were used to over the last couple of months. I think a sideways trade is probably the likely scenario here, barring any major new headlines or developments in the cash market. Same can be said with the feeder cattle market. We're developing a range, volatility is collapsing, 14-day average true range continuing to contract. So a sideways trade right along this 50% retracement, I think, is probably the path of least resistance, sideways. Now, for feeder cattle, that range could be wider. It could be 330 to 345. So be prepared to trade that accordingly. Now, lastly, lean hogs. Sharp open lower, but it was bought up. We've seen this a couple times over the last several weeks where we see a sharply lower open, but that has been bought up. Hopefully we can see that momentum continue. We have had a nice run over the last couple of weeks, so I wouldn't be surprised to see maybe a little consolidation lower. I think that'd probably be healthy for the market so we can continue to stair step at a nice gradual pace. I don't know that even though we're optimistic, I don't know that we want to see a runaway freight train. Those are obviously usually short-lived. So stair-step higher. Hopefully that is the trend into the end of the year. We remain optimistic on lean hogs, and we'll be keeping a close eye on potential headlines out of Spain with regards to African swine fever. So that's what we're looking at. If you've got any questions at all, don't hesitate to reach out. We are ready, willing, and able to help. Remember, trading futures and options involves substantial risk of loss, and it's not suitable for all investors. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for you in light of your financial condition. All information, communications, publications, and reports, including the specific material used and distributed by Blue Line Futures LLC, shall be construed as or is in the nature of a solicitation for entering into a futures transaction. Blue Line Futures LLC does not employ research analysts or maintain a research department as defined in CFTC Regulation 1.71.